Okay, hello, good morning, everybody. Good evening, good night, good day, wherever you might be. We're so excited to have you here at our latest seminar. We're so excited to have Pablo Ottonello from Michigan presenting his work on asymmetric information and capital accumulation. Just to remind you guys about the format, so there will be a video recording which will be posted on our website and YouTube later. We've invited a group of panelists that will be actively interrupting, asking questions. If everybody else, if you'd like to ask a question, please post it in the Q&A. And it's pretty cool that Pablo's co-authors, Andres and Juan, are here who will be answering questions in the Q&A. We don't currently have our upcoming seminars on the website yet because we're still working on the spring schedule, but rest assured there will be a spring schedule. In the meantime, I'd like to direct you to the lectures tab on our website, where we're excited to be anticipating a lecture on OTC market theory by Pierre-Olivier Whale and Ben Lester, who is also here. Okay, with all that, let's give it to Pablo.
All right. Hello, everyone. Thank you very much for inviting us. And thank you to all of you that are connected. This is joint work with Emi Pierdel, an excellent student at Columbia, Andres Renick and Juan Hereño, and it's called Asymmetric Information and Capital Accumulation. So the starting point of this paper is that economic theories have longly argued that asymmetric information plays a central role in asset markets, affecting the quality, valuation, and liquidity of assets traded. Given that economies around the world differ substantially in their market development and information available to market participants, a key question is, how does asymmetric information affect capital accumulation? Okay, and to what extent the quality of technologies that allow market participants to obtain information on capital quality can affect investment and income levels. So in this paper, we revisit these questions by combining a capital accumulation model with asymmetric information and micro data informing the degree of information frictions. Okay, so to provide a summary, we first develop a capital accumulation model with asymmetric information. We consider a general equilibrium framework with heterogeneous capital quality and trading of capital in decentralized markets. In all, there is asymmetric information because sellers have more information available about capital quality than buyers. Okay, buyers have access to technology to detect the true quality of capital, and the accuracy of that technology indexes in the economy the degree of asymmetric information. Now, at the micro level, asymmetric information distorts the terms of trade of sellers of high capital quality who list their capital at high prices to signal their type and are willing to receive a lower trading probability associated to that. Now, those low trading probabilities of high capital quality at the macro level translate into misallocation of capital and lower incentives to produce capital or lower investment. So then the key question to assess the aggregate effects of asymmetric information is to measure what is the degree of asymmetric information. So we propose an identification strategy based on the model micro level predictions, and in particular on the idea the degree of asymmetric information affects the relationship between listed prices and duration. Okay, so for this, we use a novel data set that contains a panel of structures, capital structures listed for trade, in which we observe the price of listed units and their duration, as well as observable characteristics. And we provide empirical evidence consistent with asymmetric information, in particular that the component of the price of a listed unit of capital that is linked to its observable characteristic has a relationship with the duration of the property of the opposite sign at the component of the price that is not linked to its observable characteristics. Okay, and then finally in the paper, we combine the model with our empirical measurement, and we show that asymmetric informations have large effect on long-run income and consumption. For example, if we were to move to an economy that has full information, long-run GDP will be 10% higher, consumption will be 6% higher. And this occurs even though the probability of a lemon going unnoticed is fairly low. That is, a technology that agents have to detect the true probability is fairly good in our estimated model. Okay, we also decompose the channels through which the asymmetric information affects output. We identify an investment channel, which means that the distortion of terms of trade that asymmetric information creates disincentivizes the production of capital. There is a capital and employment channel that this distortion in terms of trade create more delays in same capital and more long-run capital and employment. And finally, given that these terms of trade distort particularly owners of high capital quality, asymmetric information leads to a misallocation in which employed capital is of worse quality than if we were in an economy with full information. Okay, so our paper is related to several strands of the people to which everyone in this room has contributed to. And to give you kind of a panoramic overview, our model builds on the literature on asymmetric information in asset markets, and also the literature on search frictions in asset markets. Our main contribution is to show how using this micro-level evidence can inform of the aggregate effects of asymmetric information, in particular of the interaction between asymmetric information and search frictions in capital markets. And with one of the main channels being misallocation, we also connect our work to the literature on misallocation, capital reallocation, and asset specificity. All right, so what I'll do next is to discuss the theoretical framework, then go to the measurement, and then go to the quantitative analysis. So our model it builds on the standard neoclassical capital accumulation model, to which we incorporate 3 additional ingredients, which we will describe in detail: heterogeneity in capital quality, decentralized capital markets, and asymmetric information. Okay, so let me start with the most standard part, the neoclassical block of the model. So we have 2 agents in this economy, households and firms that are owned by the households. Households have standard time separable preferences over consumption and are endowed with a fixed mass of hours to work each period. They have access to a linear technology to produce capital goods using final goods. Firms, in turn, have access to a constant return to scale technology to produce final goods using capital and labor as inputs. And with IID probability, each period they exit the economy and they transfer their capital to households that is the owner of these firms. To keep the mass of firms constant, we have a new mass of firms entering into the economy in each period. Now, given this setup, households will hold capital either because they produce new capital or because they receive capital of firms that exited the economy, but they lack a technology to produce, so they are going to be the agent in the economy holding unemployed capital, and the economy that is the capital seller. Firms, in turn, that are operating have access to a technology. Any capital that they hold will be employed, and they are going to be the capital buyer. Okay, and we have precisely these mass of firms exiting the economy each period to generate a transition from employment to unemployment aligned with what that we observe in the data. Okay, so now let me start walking through the new ingredients of the model. The first is the heterogeneity in capital quality. Okay, so we consider an economy in which the capital stock is composed of infinitesimal indivisible units. And each of these units is heterogeneous in 2 dimensions: its observed quality and its unobserved quality. Both of these qualities determine the capital service that a unit of capital provides, which is a product of these 2 qualities. And the only difference between the 2 is that the unobserved quality is private information to the owner, whereas the observed qualities is common knowledge. Capital of different qualities are perfect substitutes for firms in their capital services that they provide. And as a consequence, the capital input of a firm J will be the sum of the mass of capital that a particular firm has of a given capital quality, sum across all possible qualities that the firm has.
So the fact that these things, sorry, question.
Yes,
so the
please.
fact that these 2 qualities are multiplicative, is it consequential? I suppose it could be additive or something else.
We haven't. I don't think it will be. If you think on an additive model, I don't think it will be consequential. But what is key here is our technological assumptions that we're making do help us a lot in tractability. And let me kind of take the opportunity to say that. So we are having a constant return to scale technology, and perfect substitutability across capital qualities. So in that environment, you have like an AK type of technology at the individual level for each firm. So that is what matters the most for tractability. Okay. Yes, please. Pierre?
Yeah, sorry. I wanted to ask, so you introduced the observed quality because down the road there's something in the data you're interested in.
Exactly.
What is that?
Exactly. So when we measure this in the data, we are going to have a set of characteristics that are observable. And you're going to see that the model has very different predictions for its observed qualities and for unobserved qualities. So it will be a testable prediction of the model. And it's quite nice, actually, how in the data we're going to be able to distinguish between the relationship of prices and duration between those two. Okay, so introducing these observed qualities is a useful device to bring them out to the data. Yes.
Pablo, can I ask a question? So
yes,
related
please.
to the observed quality, perhaps what I had in mind when you were describing the model as an alternative model of this is, what if the firms were heterogeneous as well in terms of the technology they operate? So let's say that there is a complementarity between the TFP of the firm and the observed quality. So then in my mind, the model I have, I don't know if it makes sense, but it's something like, then even units of capital that are of higher quality, observed higher quality, because only a few firms are going to really kind of use the full potential of that capital, then those are going to take longer to sell, just because it's harder to find kind of the right match in the sense of search and match. Does that model make sense?
Yeah, that makes perfect sense. Thanks, Nico, for that. Yeah, that's probably is likely going to be similar to a few following paper that we're considering. Let me kind of tell you the spirit of our exercise here is take the neoclassical model and analyze kind of the main effect of asymmetric information when you consider a trade occurs in decentralized markets. So we abstracted from other dimensions that could also introduce interactions with that, such as firm heterogeneity. But if you want, we're deliberately adding from that to remain as close as possible to a neoclassical frame. Okay, so that, if you want, is the spirit of our exercise to the most. But what you're saying is very interesting too. It's just that we prefer to start with this as a simpler setup in which the only mechanism is going to come through asymmetric information. And
then, but in the data, will you be able to distinguish between basically these two stories? Can it be that part of the duration story that you are finding is related to this?
Yeah, I'm going to talk. Yes, we will have a data section where we discuss other possible interpretations that you can have from the data. And just to give you kind of a short answer, we interpret the findings of the data as consistent, particularly with the type of evidence that we have in mind. But I'll talk about the data in more detail later. Okay, so then capital market is the capital market is decentralized and characterized by search and matching frictions. And we introduce these decentralized capital markets for two reasons. The first is that it's a realistic assumption of capital markets. We have micro-level evidence documenting long delay times for selling capital and patterns consistent with search and matching frictions. And the second is that there is an important mechanism in the model that interacts between search and matching frictions and asymmetric information, as were shown, for example, in the work of Guerrieri, Scheimer, and White. Okay, so in particular, we consider a directed search environment in which sellers list a price for each of their units of capital and also announce a given quality for each of their units that they have. Okay, therefore, the market of capital is organized in a continuous submarkets indexed by the observed quality, the unobserved quality, and the price of each of these units. Buyers also dedicate hours of work to search and match, and we are going to be denoted by the hours of work they dedicate to search in each submarket. Okay, there are constant return to scale matching technology in each submarket. We define the market tightness as the ratio of the hours dedicated by buyers or the capital listed by sellers in that particular market. And we denote by P of theta the probability for a seller to sell a capital unit, and by mu of theta the yield per hour of work that workers find when they search for a unit. Okay, now in the economy, we want to study the degree of asymmetric information, and that is what we want to measure in the data. So the way in which we model this is by providing buyers the access to an inspection technology. So whenever a seller lists a unit of capital, after a match is realized, the buyers have the possibility to inspect this unit with a probability psi. The buyer learns the true type of the capital quality. With a probability 1 minus psi, the inspection is uninformative. Okay, so in that sense, psi parameterizes the degree of asymmetric information in the economy. When it tends to 1, we are close to an economy with full information. When it tends to 0, we're in an economy in which buyers cannot know at all about the unit of capital quality before purchasing. Okay, now, given this technology, we need to introduce a protocol upon inspection. We assume that if no information is revealed about capital quality, or if the quality is not below the one that the seller announces, then trade takes place at the listed price of Q. But if the quality that is revealed upon inspection is less than that is announced, trade takes place at some punishment price, which in our baseline model, we consider a bargaining between the seller and buyer. If there are gains from trade, no trade otherwise at the minimum between that and the listed price. All right.
Pablo,
okay.
Yes, please. Two clarifying questions.
Yes, please.
First is the psi independent of the observable characteristics of the capital?
Yes.
Or okay, so when you go to the data, are you going to preserve that, or?
Sorry?
When you go to the data, are you going to preserve that assumption? In other words, is it just as easy to kind of learn the quality of a tractor as it is like I don't know, another piece of capital, something like that?
Yeah, exactly. So there are kind of, let me kind of distinguish your question into two. So one is about, potential different heterogeneity of capital types. So we are considering here, again, to be closer to the neoclassical model of homogeneous capital, but it's fairly straightforward to extend it, for example, for equipment structures, etc., and distinguish between that. The other is, you can make it linked to the observable characteristic on itself. We have not done that in our baseline analysis, but we definitely could.
No, it wasn't a question so much about the model, just when you thought about the data, I guess. And the other thing is, could you go through the timing just a little bit more slowly about when the info is revealed?
Right.
So these
here,
guys, they post something, a price and a quality.
Right. So here the sellers list the price and buyers search and match.
Yep.
After the match is formed, the buyers have the option.
They form a match with one person in the queue.
They form a match with one seller in particular. They have the right to inspect that unit. After the inspection is made, they have the right to choose whether to buy it or not. So, okay. But if no information is revealed, they have to buy it at the price. And if no information is revealed, they buy it at this other price, which is bargain.
Okay.
All right. Thanks.
And if they don't, they just go to the next period.
Well, yes. So here, think that they are basically buying kind of a mass of capital, so they might still buy other units of capital, but yes, they go to the next.
Yeah, exactly. But on that trade, yes.
On that particular trade, they'll go to the next one. All right. So let me walk you through each of the agents' problems. So how do households accumulate capital in this decentralized setup? Households arrive to the period with some unemployed capital of a certain type that they bring from the previous period. With probability 1 minus P of theta, they don't get to sell the unit of capital and they bring it to the following period. And this P of theta depends on the choices that the sellers make about the price that they list the unit and the quality that they announce of this. Then households invest in new capital. So I here denote the mass of capital of new quality that they produce. And we have here a PDF G that maps into, of the new capital they produce, what share goes into each capital quality of each particular type. Okay, and then the last term considers the separation flows from firms that exit the economy and transfer their capital to the households. All right, now firms in the economy have standard Euler equation that equates the marginal cost of investing, which is equal to 1 in this economy, to the expected discounted value of the unit of capital. The expectation is taken across all the different possible types that unit of capital that they produce might have. And this V is the marginal value of a unit of capital of a given type.
Pablo, can I slow you down? Sorry.
Yes,
I just want to make sure I understand. So with regards to timing, so the bargain price, is that something that the seller, is that part of what's posted or no?
The bargaining, so the seller lists the price.
Or that's all done ex post.
It's done ex post, exactly.
I see. So there could be no signaling or selection or anything like that based on that.
Nothing like that based on that, exactly.
I see. Okay.
Right.
Okay. Thanks.
We did entertain some more general forms in which it could potentially depend, for example, or our announced quality. We thought it was simpler to present this one with bargaining, but in the paper we do consider a more general function of these function Q. Okay, so many of the results go through if you allow that to depend on your A hat that you pose as well. Right? Perfect. Okay, so what is the marginal value of capital for households? So households act here as seller. So the value of capital of a given type, given that they don't have access to a technology, is the flow of revenue that they obtain from selling, expected revenue that they obtain from selling this unit of capital plus an expected continuation value. If they don't get to sell the unit, it would happen with probability 1 minus P. So these expected revenue is the sum of the probability of selling it times the expected revenue that they have from get to selling the unit if they get to sell it at the price that they listed Q, and if they sell it at this other price, if their quality is discovered, which is occurs with probability psi. Okay, so we can therefore represent ISO revenue cost curves for the sellers in the plane of Q and theta. So sellers prefer selling the unit at a high price or selling with high probability, which is associated with a higher theta. So therefore, they have these downward sloping ISO revenue cost curves, and they prefer ISO revenue cost curves to the northeast.
Sorry, just one other question, just to understand. So the probability of getting to the bargaining prices, the QTP, depends on the quality I announce. So if I announce the true quality,
correct.
Right. So here you are assuming that I never announce. I always over-report implicitly in that expression, if I read it correctly.
Right. But the punishment price that you will be going to be obtaining, for example, if you announce your true quality, is going to be Q.
Yeah. But you are always over-reporting, right? So in the announced is, in the expression you write, you are implicitly assuming you are over-reporting the quality.
You can also underreport a quality, and then you're going to have a punishment price.
Yeah, but if I report truthfully, then I will always sell at the price I announced.
Correct.
Okay.
So, I mean, this expression QP, just to clarify, this function means that, you know, if I don't over-report, then QP is equal to Q, right? That's
correct.
Okay, all right.
Correct. Perfect. So what about on the firm side? So firm's law of motion of employed capital of a given type. The firm arrives to a period with certain capital that they accumulated from the previous period. And then they accumulate capital by searching across all of the markets. So this V denotes the capital that they search of a given of each of the individual submarkets. Mu denotes here the yield that they have from each of the hours that they search in this market. And this iota denotes the share of a given capital that they have of each type, which is an equilibrium object. All right. So the marginal value for the capital firm is in turn, and this is what I was answering Pablo, that because of decreasing returns and perfect substitutability across capital quality, the marginal value for the firm is depends on the capital inputs that the firm provides, and some continuation value depends on whether the firm remains as a firm or exits the economy. All right, now firms have free entry across all of the submarkets. So as a consequence of that, we obtain a condition that tells us that in submarkets that can be visited by firm, it has to be the case that the expected cost that they pay for the unit of capital, which has two components, the expected price and the surge component, are equal to the expected value that they obtain from the capital unit. Okay, so here we can represent these ISO cost curves also in the Q and theta plane. Firms would like to pay for a low price or for a low, or to find a capital frequently that occurs at a low theta for them. So their ISO cost curves are also downward sloping, and they prefer both ISO cost curve to the southwest. Perfect. All right. So if there are no more questions, I'll start with the equilibrium under full information as a as a first step towards understanding the full equilibrium. So for that, consider just two possible observed qualities, omega low and omega high. What we have here, to those of you that are familiarized with the directed search framework, probably everyone in the audience, you have that the equilibrium for capital of each quality comes from equalizing the marginal rate of substitution between prices and thetas for buyers and sellers. Okay, so this is, for example, this point that we have right here. So what you see here is that if you have a capital unit that is of lower observed quality, that corresponds to an ISO cost curve for buyers, to a free entry of buyers more to the southwest. And as a consequence, the unit of capital that is of lower quality will be traded in equilibrium for a lower price and for a lower trading probability. Okay, and this is kind of the first prediction of the model. And
Pablo,
here, this is what I was telling you, that this is an
can I
interesting
ask you more
prediction
boring
that we can
questions?
take to the
So
data.
if
Yes.
you have, they're both convex, so is it easy to prove that there's always only one tangent point?
We are representing here the shape that they have in our quantitative framework. Under standard regularity conditions, you will have a unique point in this market. Yes. Thanks. Pierre, this is what I was telling you at the first prediction that we have is that the price under full information is higher for units of higher capital quality, and the probability of matching is also higher for probabilities for properties or units of higher quality. And the intuition is that some markets that are of higher quality attract more buyers, resulting in higher prices and lower matching probability for buyers. All right. Okay. Now let's go to the equilibrium under asymmetric information. For expositional simplicity.
Before you do that for a second, so one feature of your model is that for the buyer, searching sort of works the same way, whether you're searching for the low quality or for the high quality. So
correct.
It's sort of a better deal to search for the high quality because per encounter you get more stuff.
Exactly.
So how do we map that to like actual markets where you sort of have to decide whether to buy like a used machine or a new machine, and maybe one is better quality than the other? Do we think it makes sense to think that searching is sort of, you might, if you're going to pay one search cost, you might as well get the new one because there's more of it? Yeah.
So this is if you want, a testable prediction that we have from the model. And one, I think, is that we can bring into the data and have it as an untargeted. So you can say, okay, how do we want to parameterize the search cost? May depend on the underlying quality that you have as well. So we show that the model is, qualitatively aligned in the quantitative model that is aligned with the slope that we find in the data for observed qualities. And in that sense, we believe that the model is a good representation of what we observe in the data. But in principle, we will be happy also to entertain other functional forms as well. But the one that we picked was the most natural starting point, if you think, from the perspective of this model, and I think it's also one that fits the data fairly well. I mean, just to give you a one-liner. So in the data, you do observe the relationship between prices and selling probabilities that we're seeing here. So in the data, if you have a unit that is expensive because of its observable characteristic, the duration of that unit of quality is going to be lower. The probability of matching with that unit is going to be higher. Okay, perfect. All right, so I was saying that now the equilibrium under asymmetric information for expositional simplicity, we are going to consider a case with two types. In the paper, we extend this result also for multiple types. We consider a perfect Bayesian equilibrium under the intuitive criterion, and we study two types of equilibrium, a pooling equilibrium and a fully revealing separating equilibrium. Okay, we also focus here on the balanced growth path, but in the paper, we also generalize these results to transitional dynamics as well.
Sorry, Pablo, just one quick question
Yes.
to understand. So the case of full information, you're basically saying that the reservation value for the seller of a high quality is lower than for a low quality. So they
What do you mean exactly for a reservation value in this setup?
The cost of selling. The cost of selling for a seller of a high quality, is that relative to a seller of a low quality?
Yes. Is
that higher for the?
Yes, the higher your quality, the higher your value. Yes.
Then maybe I'm confused with something with this negative relationship, no? Because you're saying with symmetric information, it is, well, it depends on how the price is related to the.
Right. So in this price, basically the price is going to be a combination between the two values. And that is why the price scales up with the quality. So in other words, if the quality increases, a little bit goes to the seller, a little bit goes to the buyer, with this directed search framework, right? And it becomes more valuable a unit that is of higher quality, and therefore it attracts more potential buyers, and the tightness has to adjust for there to be indifference across all submarkets.
Okay, maybe we can see this.
Right, but this price Q is literally with the directed search framework going to be a combination of the two values.
Okay, maybe we can see this later when you do the asymmetric information.
Yes, I mean, if there is any follow-up on this, please let me know.
Yeah, of course.
Okay, perfect. So now, how do we construct the equilibrium under asymmetric information? Here we follow the idea of Guerrieri, Scheimer, and Wright, and we start with the low type, and we consider what will be the problem that the low type will pick under full information if its type is revealed. Okay, and that is a choice of price subject to a free entry condition for the buyer in which the value of its quality was actually revealed. Then we go to the high quality type, and we say, okay, what will be the price that the high quality type would pick if the ISO cost curve for the buyer, the free entry for the buyer, is satisfied under the assumption that the buyer believes that it's of a high quality type, and under a no mimicking condition that tells us that the value for the for the low quality capital under their full information choice is not below the value that seller would have by mimicking the allocation of the high quality type. All right, and I'm going to give you more graphical analysis in this in a second. But in the paper, we show that there exists a unique, fully separating equilibrium that satisfies the intuitive criterion, and there is no pooling. Okay, so this is the equilibrium that I'm describing to you with this set of problems. So how does this work? Let me kind of represent you this graphically. So let me come back to the equilibrium under full information, in which the high quality picks this point and the low quality picks this point. And then we consider now these no mimicking conditions that are also downward sloping. In the way of reading this is for a given Q. If you pick anything that is to the right of this curve, you will be mimicked by the low quality type. Okay, so if we first start in an environment in which the technology of discovering lemons is sufficiently good, then the seller of the high quality type would be able to implement the allocation under full information, because the low quality types know that they are detected with such a high probability that it's not worth for them to try and to mimic. However, if we go to an environment that has more asymmetric information, in particular, it has a lower probability of a lemon going unnoticed, then this point is not feasible anymore as a no mimicking point, because in this point, the seller of the low quality capital will be mimic the allocation of the high quality capital. So then what the high quality capital does is to say, okay, of the ISO cost curves from the buyer, this is the free entry of the buyer, which point is the one that gives me a higher ISO revenue, conditional on this no mimicking condition that you see here, that you see that it has this point right here. So what you see that what the buyer is doing, so what the seller of high quality capital is doing, is that they are picking a point with a higher price than they would have under full information to signal their type, and that is associated with a lower trading probability. So what the seller of the high capital quality does is to delay selling as a form of punishment. They know that for them, waiting is less costly than it is for the low quality type, because with some probability the true type is discovered, and therefore waiting is more costly for the low quality type than it is for the high quality type. So this is the form of punishment that the seller of the high quality type has in this environment. Now, another property that you see from here is that the worse the technology to discover lemon becomes, the more the high capital quality has to distort its terms of trade, the more has to increase its price to signal its type, and the lower the trading probability that it has associated with. Okay, so prediction number 2 of the model under asymmetric information is that asymmetric information affects these terms of trades for the sellers of high capital quality. In particular, we find that the price that the seller picks under asymmetric information is higher than under full information, and that it trades with a lower trading probability than under full information. Okay, and again, the intuition is being that the seller of the high capital quality signal its type and is willing to accept a lower trading probability for it. The other thing that is important here is that the distortions in this economy are governed by this psi, or degree of asymmetric information. Okay, and in particular, the lower the probability of the buyer discovering the true capital quality, the more these ratios of matching probabilities for the low and high quality start being. All right, so in that sense, is that the relationship between prices and duration is informative in this model about this degree of asymmetric information. All right.
So I guess that goes back to Ben's question earlier, that this is under the assumption that psi is the same across.
Correct.
Yeah.
Correct. I mean, we would be happy to entertain such a type of richer setup. I mean, we thought that this is kind of a good starting point to, especially to understand the game mechanism. Yeah.
Pablo, can I ask a different question? So you guys are thinking about psi as one measure of asymmetric information, which is kind of reasonable. But you can also think about other measures, like for example, the difference between AH and AL.
Oh, absolutely.
Right?
Absolutely.
Or the fraction of low versus high type, something like that.
Yeah.
Have you guys
absolutely.
played around with comparative statics with respect to any of those measures of asymmetric information?
So in the quantitative analysis, definitely we are going to have these two as the measures of the degree of asymmetric information. And the way which we are going to discipline it is going to be with the component of prices that is not observed that is not explained by observable characteristics will be informative about the dispersion between these different types, and then the slope between prices is going to be mostly informative about the degree of asymmetric information measured by psi. But I agree with you that it's something.
I guess one problem you have with what I'm asking about is that like an unpleasant part of the Guerrieri-Scheimer right equilibrium concept is it's independent of the distribution of low and high types. You just distort the hell out of everything, regardless of whether there's epsilon bad types or lots. The difference between AH and AL doesn't matter. So I guess some of these things I'm asking about, they're probably actually not that responsive to some of these measures of adverse selection.
Right. Well, definitely the value that it takes, it also can play around in terms of how much you are going to be distorting. But the mass.
Right. I guess because you have free entry of buyers.
Right.
So the difference between A. Okay, that's right. Okay, thanks. Sorry.
Thank you. No, now we're going to go to the measurement part of the paper. Okay, so with this prediction in mind, that the degree of asymmetric information distorts the allocation for this. Okay, so for this we use a novel data set on a panel of capital structures listed online for sale and rent. This includes retail, office, and industrial space at the monthly frequency in which we observe the listed price of a property, and we have information about its location, and its location is here a neighborhood, for example, within a city, so it's a pretty good location of the exact address actually we have. So the age of the property, its size, number of rooms, etc. And we also measure, given that this is a panel, we have a measure of the duration, the number of months that the property remains listed. Okay, we also have, like, as a validation, measures of search intensity, for example, the number of clicks that a property received or the emails that the property received. The source for this data set is called Idealista, that is a leading online platform of the real estate market in Europe, and we have more than 1 million properties covering the period between 2005 and 2018. All right, so now the key thing that we want to do to map this data to the mall is to distinguish what we had in the mall. This is, Pierre, a little bit what I was explaining. These are we want to have a concept in the mall that can be mapped to these observed qualities and a portion that is explained by unobserved qualities. Okay, so what do we have as observed qualities? Okay, so we need to take a stance on what are elements that the agent observed, and then they are arguably can be linked to this omega. And we pick here things that are very easy to observe, such as the year in which it was posted, the location of the property, the type of property, either if it's office, retail, the size of the property measured by its area in square foot, the age of the property, the number of rooms that it has, and etc. Okay, so everything that is easy to understand that is on the listing. So what we do then is to run a hedonic regression on the price of the property, explained by location by month fixed effects. So these are dummies for each month and for each neighborhood. So for example, think about Madrid or Barcelona, a neighborhood within each of those, and explained by observable characteristics, including the area of the property, etc. All right, so if you want to think about how much is explained by these observable characteristics, we start from a distribution of prices, which is this blue histogram, then the year and location explain a lot of this variation. Okay, 60% of this variation in prices is explained by the year and location of the property, and then up to 75% of the variation is explained by these observable, what we label observable characteristics, which are these characteristics that listings have. Okay, what you can see there is that you have less variation in these residual prices, but you still have a substantive amount of variation, and is what we're going to be attributing to these unobserved characteristics. All right, perfect. Okay, so here comes the key empirical result that I want to emphasize. And in these scatter plots, we have on the horizontal axis a component of the price, and on the vertical axis the duration of the property. Okay, so on the left panel you have the predicted component of the price, which is how much of the price is predicted by these observable characteristics. And on the horizontal axis in the right panel, you have how much of the price is goes to the residual or is not explained by these observable characteristics. So the left panel tells you if a property is expensive because of its observable characteristics, then it tends to sell faster, have a higher probability of selling, or a lower duration, okay? Or downward sloping a line between duration and predicted component of prices. What the right panel tells you is that if a property is expensive beyond its observable characteristics, it tends to have a higher duration in the platform or a lower trading probability. And you see it here, this is consistent with the predictions that I showed to you in the model before. In particular, what you have here on the left panel would be consistent with the predictions of the model under full information, or for particular for the omega, for the observable characteristics. And what you have here will be consistent with an environment in which asymmetric information distorts you so much that you start having the opposite relationship in sign that you have for observable characteristics. So Pablo, here is that I was telling you at the data, if you want, validates the relationship that we're assuming for search across different characteristics. Okay. Perfect. Now, if you want to see what are the moments about this that we're going to be taking to our quantitative analysis, so we have here a regression of duration on the component that is predicted by the price and the residual of the price. And this particular slope is the one that is going to be informative about the relationship between duration and residual prices. We're going to be using these as an untargeted moment. Yes, Pierre?
So, Pablo, you showed us a relationship for rental and sales.
Yes. Yes.
So model of asymmetric information sometimes views rents and sales as different mechanisms that are exposed differently to asymmetric information.
Yeah,
but,
for sure.
How do you square with that sort of theoretical view?
No, so that's a very good point. So you see, so let me answer kind of in a couple of steps. So we wrote down a model with sales. So the moments that we're going to be taking to the data are those of sales. So, okay, so we're going to be consistent between the data and the model. Here, if we want, we are also showing you the data for rents, kind of as an additional validation of the exercise. Now, if you would like to think about, for example, would asymmetric information be more or less powerful, for example, in rents, you will typically think that the asymmetric information will be less important for rent because in principle, you can go out from the contract. And you see that this line is less steep, for example, for rents. But we didn't write the full model with rents. So we are being, showing us additional evidence that could be interesting, but we are trying to be as consistent as possible between the data and the model. So we take the model for the moments that I'm showing you here in the regression are for sales. Okay, so and this is the ones that I'm going to be taking the model. Now, if you're interested, we also have the ones for rent. Thank you. All right, and this is what I was asking. I think Nico was asking a little bit of that, or Ben, or both. They were asking about, how can we distinguish kind of other potential explanations that could be driving this relationship. So in the paper, we do an extensive analysis to argue that the relationship that we observe here between residual prices and duration is not explained or would be hard to explain by other potential theories that you might have in mind that could also give you qualitatively this relationship. Okay, in particular, we consider whether it could be explained by some indifference condition between price and duration, as in Burdett-Judd style of models. We show that indifference would be hard to square with the data. We also argue that introducing heterogeneity between sellers and buyers will be hard to square with that. And we are not saying that none of these explanations are not in the data. What we're saying is that they are not explaining the particular relationship that we find. And I'll be interested in entering more into these potential explanations if you are interested. All right. All right, so now we do the quantitative analysis combining the model and the data. So the strategy that we take for our model is to do a two-step procedure. We first fix a subset of parameters matched to standard values. a lot of these are parameters that come, for example, from the neoclassical model, such as the discount factor, the share of capital, the growth of technology, the growth of population, and the exit rate of firms. For all of those who take data that is fairly standard. We parameterize the bargaining power of sellers in this bargaining protocol that occurs if there is a lower quality that is revealed to 0.5 as a benchmark. And then we take the curvature of the matching technology as was estimated in previous literature of 0.8, okay, using similar data and the one that we're showing. Now, the key parameters that we inform with our data are models that have to do with the strength of asymmetric information and search frictions in the model. So for asymmetric information, as Ben was saying, there are two parameters that are key. One is the standard deviation of unobserved quality, and the other is the accuracy of the inspection technology. Okay, so the two, I mean, here there is not a one-to-one mapping between parameters and moments, but the two moments that are more informative about these two parameters are the standard deviation of residual prices and the slope between duration and residual prices. Okay, so we target this slope that I was telling you before in the data, and with the standard deviation of residual prices that we observe. Okay, then for predicted prices, we associate these to the standard deviation of observed capital quality, the standard deviation of predicted prices that we have in the data. We map that. And then for matching the strength of search and matching frictions, we set the efficiency of the matching technology to match the mean duration of properties in our platform, which is around 8 months. All right. Perfect. We also validate here, coming back again to your question, Pablo, of, to what extent is the search that we're assuming consistent with the data. If we run exactly the same regressions in the model simulated data as we run in the data, we'll also recover a negative slope between observable characteristic, the predictable component of prices, and the duration of those properties. Okay, so in that sense, these are the untargeted moment, which is the relationship between predicted prices and duration in our model, is consistent with the one of the data in an untargeted fashion. So that is coming from the assumption of the shape of the search form that we're taking. All right, perfect. So now let me show you how asymmetric information affects capital market variables, if you want, at the micro level. So what we're showing here is on the horizontal axis, the log of the unobserved quality, A, for different properties. And here we're plotting policy functions, which is what is the price that a seller of unobserved qualities of different type will list, and what will be the associated selling probability with respect to that. So here in our baseline, we have a psi of 0.92. And this is what I was mentioning, that in the baseline calibration of the model, the probability of a lemon going unnoticed is very low. It's only 8%, all right? So what you see in the policy functions that we're plotting here is that there is this upward sloping relationship between the unobserved component of capital and the listed price. And there is this downward sloping relationship between the log of unobserved quality and its price. All right, now how does asymmetric information affects this relationship? So you see that the worse the asymmetric information is, the steeper this line becomes. So the more sellers of high capital quality need to separate themselves by listing high prices, and the lower there is the probability associated for them to sell. If you go to the prediction that is close to an economy close to full information, you start recovering the theoretical prediction of the model for observed qualities, that there is a positive relationship between the listed within the unobserved quality and its selling probability. Okay, so the quantitative model gives you this discussion of that we were showing in the theoretical part of the model. All right. Now, in our economy, to analyze the macroeconomic effects, it is useful to express the aggregate output as the product of labor services and capital services. And I'm going to be concentrating on the different channels through which asymmetric information affects these macroeconomic aggregates. Okay, so we can represent aggregate output in the economy as three different components. So the first component is a total capital stock that the economy has. Okay, so this is just summing across all units without weighting them for quality. The second component has to do with the capital and employment rate in the economy. Okay, what's the share of units of capital that end up being used in production, and that as a consequence that provide capital services. And then there is a third term that refers to the quality of unemployed capital, which is a covariance between the capital services that an individual unit provides and the unemployment rate that those units have. Okay, and this is a measure of how much is the quality of your employed capital, of the employed capital that you observe. Okay, so now the key idea with these three components in mind, let's see how asymmetric information affects these macroeconomic aggregates. So what we have on the horizontal axis here is the quality of the signal or the accuracy of the inspection technology. And on the vertical axis, we have different macroeconomic variables. Here we have output, and here we have the three channels that I showed you before. Okay, so you see that the more the economy is close to full information, the more output it produces. The output of an economy with full information is going to be roughly 10% higher than in our estimated baseline economy, which comes with these gray lines. And you can see that both the three factors are contributing to this. A high stock of capital, a lower unemployment rate of capital, and a lower covariance of unemployed capital with quality. So let me kind of walk you through each of them. So first of all, there is a high stock of capital because the distortion of terms of trade that asymmetric information introduces operates like a tax on investment. In particular, if you end up having a capital unit that is of a very good type, now you are going to be able you're going to have to signal yourself, and you're going to have to wait more for selling. Okay, so it's a tax on, if you're lucky and you get a very good high quality of capital, you're going to have to wait a lot to sell it, and that's a tax on investment. In addition to that, you have that sellers here are waiting more because of the signaling. So as you approach the economy with full information, you start having less capital and employment. And finally, given that asymmetric information affects sellers of high capital quality, as you approach an economy with full information, those that precisely now can sell their properties faster are the sellers of high capital quality. Okay, so that is why the covariance between unemployment and quality declines. If you want to have a quantitative sense of these three channels, you see that the output effect of going through full information will be roughly 10%. And the main channel here, it's an investment channel. So here it is worth mentioning that consumption will also be around 6% higher on the steady state. And the investment channel leads to a 6.5% of output effect. Okay, so the way in which you are computing these channels is that if you only move the capital stock towards full information, if you only move the capital and employment rate to full information, or if you only move this covariance between employee units to full information, how much did you get? You see that most of the effects on output is coming through investment, but misallocation contributes. And within misallocation, the component of misallocation that is more important here is that units become less unemployed, or the average waiting times decline in the economy under full information. Okay, to conclude, asymmetric information has important macroeconomic implications that affects investment, misallocation, long-run income and consumption levels, and we are thinking on the that it will be interesting to study potential inefficiencies that can arise from these potential distortions from asymmetric information, or also a setup in which these information acquisition or these technologies become endogenous.
Okay, Pablo, thank you so much. I was getting ready to give you a 5 minutes notice, and then I thought, okay, let's see, he might be just getting ready in time. This was awesome timing. and an awesome presentation. Thank you so much. So we have 15
Thank
minutes
you
for
very much.
discussion.
Thanks, everyone.
I see
Yes.
Zach raise a hand, but first I'd like to especially invite the attendees. Everybody who's registered as an attendee, if you have a question, please raise your hand and I will call on you. All right, Zach, you were first.
Oh, so you don't mention welfare at the end of with the quantitative exercises. Do you guys compute this? I was interested because you have the information side of the welfare effects, but then you also have this like kind of Hosios or composition effect between bargaining and competitive search. That's going to get you some welfare effects. In fact, it seems like it could get you kind of the opposite direction. There could be overentry of buyers, and because you have a difference between the elasticity of the matching function and the bargaining share. So I was wondering if you
that's a very good point.
guys looked at welfare.
We haven't yet, and so thanks for suggesting it. So just let me point out from where the potential inefficiencies are coming from, and we're thinking on where to incorporate that to the paper. So here, if you just like to take the search block of the paper, and everything will be efficient because of directed search. So the inefficiencies only come from the information friction side. There is one potential scope of banning the signal, if you want. And that on itself potentially can have some welfare improvement depending on the share of lemons and how bad the lemons are. And the other is the one that you are saying that comes potentially from bargaining. So those will be kind of the two welfare side. But we're definitely, because the exercise that we're saying so far is, if technologies will be better, like, how much would you gain from this? But as you're saying, like one of the main things that we want to do down the road, we're still thinking if in this or in another paper to analyze the potential policies that you can do out of that. In an early version of the paper, we did that kind of with this idea of banning the signal and analyzing the welfare implications. So we're tempted to actually incorporate it to this paper.
You're next.
Thank you. Hi, Pablo. This is very good. And I have one question about whether you have looked at whether your model can match the dispersion, residual price dispersion. The reason I'm asking that is, in fact, if you take a Bardet chart and if you try to use that to match in a dynamic model, try to match the residual price dispersion of, say, housing market, it's really difficult. This is also related to Hosting, their paper on that, because you can always just try next period, right? If you wait one period, that doesn't really mean much. So the dispersion cannot be high. But I guess it would be good to play that up a little bit, to distinguish, to say that that's one direction that the symmetric information might be more appealing, I think.
That is a great point, and thanks for raising it. So let me tell you kind of what we did in the data. So we take very seriously the possibility that what was going on in the data was potentially some indifference between prices and duration. Just to put everyone on the same page. So one could say, well, we are in the ISO cost curves for buyers. What if this relationship that we see between prices and duration of properties that are very expensive, taking more time to be sold in terms of their unobservable characteristics, just reflecting an indifference condition from sellers across duration and prices. So what we did to test potentially that in the data was to compute the expected revenue that you would have conditional on the prices and the durations that you see in the data, right? So you can think about it as follows. So think about computing the net present value of listing at a given price and selling it with a certain probability, and what is the net present value that you obtain. Of course, you need to take a stance there on the discount factor and potentially your risk aversion that you have out of that. So let me start kind of with a simpler example. Imagine kind of you're in a linear world with a standard discount factor. What you have are upward sloping relationships in terms of net present value, meaning that sellers will be always better off by listing their prices at high, by listing their units at high prices. So if you care to give them the menu of options, they will be really indifferent. You should observe that everyone is really indifferent across them. So, but you see upward sloping lines that indicate that in principle, sellers will be better off by listing units at high quality. Of course, after you introduce that information, that cannot be the case because that is a menu of options that you cannot really pick without making yourself discover with some probability. But in principle, we'll tell you the relationship that we see cannot be reconciled with that. And then what we did was to say, okay, how much this can be driven by discount factor or by some risk aversion. So we show that these increasing net present value conditions hold for every discount factors that you can pick. So even if you pick a discount factor of 0, you will be better off by listing the unit at a higher price. And then to analyze risk aversion, we say, okay, what if you make a worst case scenario of what's the, in the distribution of durations, like pick the one that is, more conservative, you would also be better off by listing your capital at a higher value. So we think in that sense that what we are calling asymmetric information cannot really be explained by some indifference condition on the seller side. We also analyze the potential of heterogeneity in sellers holding costs. Like a connected question could be, how large will have to be the selling cost for the seller to be indifferent, and it gives you like a very, very high cost of selling the property to reconcile that. So in that sense, is that we think that what we are labeling asymmetric information cannot be explained by other potential theories that will give you the same relationship.
Awesome. We have Mohammed is next, and we have five people deep question list. So keep that in mind as you ask your questions. And Pablo, please keep that in mind.
I'll try to be brief.
Okay. Hi, Pablo. This is Mohammed. So
hi, Mohammed.
I'm sorry, my video didn't work because perhaps I need to restart my computer. Anyways,
no worries.
So I have a question. I may have missed it about the alternative theories that you put there.
Yes.
One is about this kind of common imperfect information, meaning that maybe both buyer and seller share some uncertainty about the asset. And so how do we know that this is not about that? Because especially I think in your context, which is more like house and this type of things, so whether this is really asymmetric information or it is just some uncertainty about the value which is shared both by the buyer and seller, it's hard to distinguish that. And then maybe my question is that how can you rule out this alternative explanation? I don't know if my question is clear.
Yeah, you cut it off a little bit, so there might be also some uncertainty in on that. So
basically, my question was about like uncertainty about the value shared by both buyer and seller. So how can you rule out this?
I mean, we can definitely think about that more. We can think about that more. My sense is that if there will be just some uncertainty, and think that anything that is in principle noise into here, it's not clear why it will have the particular relationship that we're finding with duration. But I'll be happy to discuss to follow up more and think more about it. Yeah. Thank you.
Okay, thank you. And just one quick thing is that also, I don't know, in your references, so Delacroix and Xi jet paper. So I don't know if you have seen that paper, but that one is also very close in terms of the signaling. And even to be more precise, maybe that's more related to your concept than Gary-Schemmer, right? Because Gary-Schemmer is a screening game, not signaling. Of course, you can kind of extend it and kind of adopt it to say that we just kind of induce intuitive criterion. But yeah, I just wanted to kind of talk about this paper. I think that one is also very related. Thank you.
Perfect. Thank you very much for that connection.
Ben, you're next.
Okay. So a related question. The explanation I was thinking about, you also thought about, which was the second bullet point there, the heterogeneity in seller's impatience. Could you just go over what the sort of how you ruled that out? I didn't. You went through it fast.
Right. So let me put it as well. So we see upward sloping net present values. So if you ask the following exercise, if you were to list at different prices, what is the net present value that you would obtain? Okay, and what we see is that if you would have a zero net present value, a zero discount factor, you will still be better off by listing the property at a higher price. So I can maybe show you if you want.
Yeah, I mean,
Lucas,
I guess I just didn't. I mean, at a very basic, I'm missing something at a very basic level. You see that houses or whatever properties that seem to be priced relatively low sell fast, and you know, once you residualize, and those that seem kind of expensive take a long time, right?
What I'm saying is that take the extreme of impatience. So take the extreme in which you are a patient seller and I'm a very impatient seller, right? So what I'm saying is that if we compute for the super impatient seller, beta equals 0, that seller will still be better off by listing at higher prices. So in that sense, it will be very hard to identify this as some indifference condition plus heterogeneity in this context.
That's somehow like through the lens of your model with all the specific.
No, it's a very simple net present value type of computation. So if you assume like some linearity, you can say, you know, what will be the net present value of a stream of flows in which with probability each period you sell the property or you do not sell the property. So it's a kind of a very, under linearity is a very simple computation of net present value that you can do.
I see. And then just so I understand,
and if you dislike linearity, is that we can go to the extreme form of risk aversion in which you assume that what's the worst possible realization you can have of duration. And even if you take that into account, you will still be better off by listing the unit at a higher price.
Okay. All right, I had more, but let other people, we'll talk later. Let other people ask questions.
Okay, on the question list, we have Yanis, then Pablo, then Nico.
Awesome, thanks. That was awesome, great paper.
Thanks.
Clarification and maybe hinting on the identification. So there is this feedback between, I guess, search frictions and asymmetric information. And
yes,
so can you distinguish between these two somehow? Like, of course, you need both of them to get the results, but if you could distinguish, because so your identification argument is about duration, but naturally one could think that duration is of search, you know, due to search friction. So can you distinguish?
Yeah. So something we do something we verify is that the same relationship that we have here with duration, we also have it with clicks. So if you think the way in which we construct this beverage curve, if you want in a capital market, is, you know, you need some measure of search intensity. So instead of having, you know, vacancies or something like that, you can have like a measure of clicks, right? So clicks is a measure of interest. So if we compute the relationship with clicks, which will be a measure of search intensity, it will also go in the same direction of the model. In other words, if a property is expensive because of its observable characteristics, it tends to receive a lot of clicks. And if a property, or a lot of search intensity, and if a property is expensive beyond its observable characteristic, it tends to receive low intensity. So this tells you in principle that the durations that we're observing in the data operate through this non-Walrasian search and matching model, in which you can actually measure the mass of search that you are obtaining. That's a good point that we should highlight more. Thanks.
And can you distinguish? Sorry, and you can residual the results out of that and tell us only about search friction, asymmetric information in some sense, or that's too much to ask for?
We haven't done it, so we did it, if you want, as a validation exercise, because so the only kind of problem with this measure of search intensity that I'm suggesting is that it's less easy to map in terms of to the units of the model. So duration is one that for us it was kind of simpler to match. But you know, in other work we've done in the past, it's like you can actually, for example, if you think more on the dispersion of search, we can. It's a good idea. We can do that. We'll be happy to do that. Yeah.
Thank you.
Thank you. I see Pablo and Nico.
Yeah. So think of the capital stock is made up of commercial real estate, residential real estate, and equipment. Do you have any sense of whether the sort of the dynamics of the used market for each of these things, how like residential real estate and equipment look in terms of how long these things are unemployed, what the secondary market looks like, and so on?
Yeah, that is a very good point. Thank you. So there is work informative in terms of the same type of frictions that we have for structures are likely to hold for equipment. So for example, the work by Alessandro Gavassa has done a lot of work, for example, characterizing equipment, showing that the patterns that you see in there are observed for equipment. You know, for example, airlines markets, used car markets, etc. The study by Ramey and Shapiro originally also documented long delay times for equipment. And if you want to have like some comparable units, I think a useful study for that is a recent paper by Kermani and Mad, in which they measure asset specificity by measuring the values of the capital of firms that go bankrupt, for example. So they share with us kind of separate estimates for equipment and structures, and you see that arguably the recovered values for equipment are even less than those from a structure. So overall, I think the evidence out there is that the type of frictions that operate in equipments will be even higher than for structures. These slopes that I'm showing you here, unfortunately, require some very specific data that we don't have. But if you take a kind of some indirect evidence coming from all of these studies that I'm telling you, in principle, you will say that the asset specificity, the delay waiting times that you have for equipment are maybe even stronger than the ones that we have for structures.
Okay, me. Hey, Pablo. It was a very nice presentation.
Thank you.
I have a question about perhaps motivated by my own perception of how the residential market works, or at least what I've seen of the residential market, which is so if a house stays in the market for longer, my impression is that they can signal that actually it's of low quality. And a way to see that is that, again, my own perception is that houses that stay in the market longer are going to see a price reduction, right? So perhaps relative to your data, one question I have, so relative to the model is there room for this type of signaling, and how would that work? And second, in terms of the data, basically this graph of longer duration and residual price, my question is the price the same at period 0 than at period cap T where it was sold?
Very good question, thanks. So we did at some point analysis based on that didn't enter the paper, but we did end up seeing, for example, if there were downward revisions in prices for units that were systematically linked to their duration. So my co-authors can jump in if they remember better than I do. My recollection is that there were no systematic relation, but we have to check again those results.
Yeah, the idea basically was suppose that these residual prices are, let's say, take it to the limit, let's say that they are mistakes. Are these mistakes correlated with future hazard rates of price decreases? And we didn't see any kind of big heterogeneity across groups. So it's not that these guys figure out, oh, look, it's taken super long. Maybe I set the price that was too high, and therefore it increases the chances of price adjustment. No, we don't see any heterogeneity.
Okay, that's the end of the speakers list, but as long as Pablo is willing to take questions, we can stay
here. We are happy to stay here as long as people are willing.
Well, as long as you have questions. So who wants to go next? Oh, and if there's no more need for intense discussion, then I will end the recording here and the official part of the session. Thank you all for being here.
Thank you very much.